Hello everyone, this is Alec, Karanikolas, and today we'll be talking about how to use options to buy and sell shares. So this is not necessarily for a hedge or for a speculative investment, but more so for a long to medium term outlook on how you can use call and put options to be assigned shares or to sell shares that you have in a covered call. So this is meant for a beginner's guide or to intermediate, as I will not be talking about any advanced option strategies. It's just simply selling a call or selling a put. So the basics. So there are European and American options. European options cannot be exercised at any time, so they are only exercised at expiration if they're in the money, whereas American options can be exercised at any time until expiration. So buying a call allows you to buy 100 shares of a stock or an ETF at a certain strike for a given amount of time. Selling a call gives another investor the right to buy 100 shares at a certain strike for a given amount of time. So you are obligated to sell them 100 shares. So you will either be short 100 shares, or if you have 100 shares, then you will sell those 100 shares at a given stock price. Similarly, a put is kind of the opposite. Buying a put allows you to sell 100 shares. This is oftentimes thought of as insurance for some investors, which is what they use as a hedge, but we will not be talking about that here. Solely using options to be assigned shares. And selling a put gives another investor the right to sell 100 shares at a certain strike price for a given amount of time. So when determining the price of options, the Black-Scholes equation is what comes to roll. And in this equation, there are multiple variables, which are labeled the Greeks, as labeled here. I do not want to get into them too much, but I just want you to know that they do exist. So delta indicates how much the value of an option should change when the price of the underlying stock rises by $1. So if you have a call option, if the stock goes up, holding everything else constant, the price of the option should go up. Gamma is how much this delta should change for every dollar the price of the underlying asset increases. Theta is a very important option as well. It is time decay. So if nothing happens once a day expires, the option will lose money due to its loss of extrinsic value in the time decay, which is labeled theta. And vega and implied volatility are also very important. And it's how an option's value changes due to the volatility. So when a stock or ETF is more volatile, holding everything else constant, the options will be more expensive. And rho is how an option's value changes due to interest rates. So other common terms that I will discuss in this presentation and common abbreviations that you will see are in the money, out of the money, DTE, which is in the money, ITM, out of the money, OTM, and DTE, days till expiration. So a contract is in the money for a call if it's below the underlying price of the asset, and for a put if it's above the underlying, and out of the money it's just the opposite. So when you look at an option chain, this is from Market Chameleon, which provides great information, and this is for SPY, which is an ETF for the S&P 500, when the S&P 500 was currently trading around 2,720 points. So if you would want to buy, you can see the bid-ask spread right here. So for a at-the-money call, the bid is 117 and the ask is 119. So if you want to buy a call, you'll have to spend between $117 and $119 to have the right to buy 100 shares at 272. And similarly, for a put, it is between $106 and $108 that you'll have to spend to buy this contract, which gives you the right to sell 100 shares of SPY for $272 a share, and this contract expires March 21st of 2018. So this is a very short-term option, very few days till expiration. So for assignment and what I'll be talking about, if you sell a call, you must sell 100 shares at a given stock price, which is the strike price. And if you sell a put, you must buy 100 shares at a given strike price. So this is what we'll be discussing today, is how you can buy stock for cheaper than the asking price. So if you sell a cash secured put, this can allow you to obtain shares at a discount. And the negatives are that you obviously do need the funds to buy at least 100 shares. And it is best to do this once the underlying asset's price has dropped and or implied volatility has risen. So now I give you an example. Let's suppose XYZ is currently trading at $100 per share, and you would like to add this to your portfolio for some reason. Whether to like the fundamentals, it would add great diversification. If there's something, if earnings are about to be released, or whatever the case may be, you want to add XYZ, and it's currently at $100 per share. So you can buy 100 shares for $10,000 and immediately have the 100 shares. This can be useful if you think that the price of the stock will dramatically increase in the future. If this is the case, then you might not want to sell a put and you might just want to buy shares. But if you think that it might just go up a little bit or you're not entirely sure but you want it, then it can be beneficial to sell a cash secured put and receive premium. So let's suppose that you sell the 95 strike put that expires in 1 month from now for $1. This will net you $100, which will be credited to your account. Your account will lose $9,400 in buying power because you need the $9,500 in cash at hand to buy 100 shares of XYZ. And since you received the 100, you only need to use $9,400 in buying power because you've already gained 100. So what might happen if you sell this put? The stock might stay above $95 per share. If this is the case, then you will not be assigned 100 shares of XYZ, and you will not have any XYZ in your portfolio. However, you will pocket the initial $100 in premium, and this will give you a nice sizable, decent return of 1.06% in 1 month in this example, which if you take it 12 months in a year and you do this every month, netting 12% fairly easily is something that would be very beneficial for many investors. And let's suppose that the stock goes below $95 per share. Then you will receive 100 shares of XYZ at an average share price of $94 per share, which would mean a good thing that you did not buy it at $100 per share, as you were buying it essentially at a discount now, and you were preventing yourself from giving into any biases of buying the stock earlier. So let's say now you have 100 shares and you want to sell a stock for a premium. So this is called selling a covered call, which many people do for income. And the negatives are that you must sell at least 100 shares, and you cannot sell the 100 shares once you have an outstanding option, as you do not want to have undefined risk in most circumstances. And it's best to do this once the underlying asset's price has risen and or implied volatility has risen. And this is also beneficial if you have difficulty selling a stock, even if it reaches your target price. So if something is trading at 100 and you want to sell it at 105, it can be beneficial to sell a call at 105, which will force you to sell the stock at 105. So now let's say an example. Let's suppose you own 100 shares of ZYX in your portfolio. It is currently trading at 100. And you think that you want to sell it in the near future, or you do not mind not having it in your portfolio. So you can sell one covered call and receive a premium. So suppose you sell the 105 strike call on ZYX that expires in 1 month for $1. This will net you $100 in your account, so you immediately have $100 credited to your account. This will increase your buying power by 100 in your account, but you cannot sell the shares without having undefined risk, as I mentioned earlier. So what might happen if you do this? The stock might stay below $105 per share, which means that you will pocket this $100 in premium and still have the shares, which is very crucial. So if the stock stays at 100, this means that you will have earned 1% on your money in 1 month. The negatives is that the stock could fall in price, which could cause you to lose money on your shares. Another way of thinking about this is you are essentially lowering your cost basis per share, and you're having a lower cost than that you bought the shares at. So now it's essentially you own the shares at 99. So if this is the case, you can also repeat the process, rinse and repeat, sell another call, essentially same days to expiration, same price and repeat the process and keep netting some money in premium. And let's say this stock might be above $105 per share at the end of the month. This means that you will sell the 100 shares for a price of $105 per share while pocketing the $1 per share in premium initially. This will realize you a return of 1% on the contract and 5% on the shares. So this will be a 6% return in this hypothetical example in 1 month, which would be very nice. Even if the stock goes to, let's say, 120, you really cannot complain with a 6% return per month in a fairly safe manner. So just going over in the money and out of the money again. So if you really want to buy 100 shares, then you should sell a put closer to the current stock price. So it should be closer to in the money. And if you really want to sell 100 shares, similarly, you should sell a covered call that is closer to the current stock price. So it's closer to in the money. And you should rarely sell a contract that is in the money. You should always at least slightly out of the money. Let's say it's trading at 100 and you want to sell a put, at least go to 99. Don't go to 101. Because even if the stock stays at 100, you're still netting a nice premium. And the further out of the money, the less premium you will receive on your sold option. And the more in the money, the more premium, which is just going through the probabilities. So in conclusion, selling a put allows you to earn a premium and to potentially purchase shares at a lower price than you otherwise would have. And selling a covered call allows you to earn a nice initial premium and to sell shares at a higher price than you otherwise would have. So let's say if you had a order to sell 100 shares at 105, good to cancel, let's say 60 days, you'd be much better off selling this call instead and not even having to look at it for a prolonged period of time. So for a put, you must have cash available for 100 shares at a given strike price. For a call, you must have 100 shares of a stock or an ETF. And the worst case in both of these scenarios is the stock price to decline dramatically after you sell a call. So I hope you liked my presentation, and I encourage you all to do your own research, to pay attention to the markets every day, and to start investing. But I am not a licensed investor, and all of your decisions are your own.